You're about to hear my conversation with Shah Khan, portfolio manager and co-lead of Mackenzie's Bluewater team. We'll talk about the Bluewater team's approach to investing, the big topics of the day that continue to be in the headlines, such as AI, China, and the energy transition, along with what the team thinks of the Canadian equity market right now. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, VP of Investment Strategy and Portfolio Solutions. Today, I'm joined by Shah Khan, who co-leads our Bluewater boutique at Mackenzie. Shah, thank you for joining the podcast today.
Thanks for having me, Rajan. Happy to be here.
Shah, I want to start our conversation from a high level. Let's talk about your approach to investing. Walk me through your philosophy and what's the process that has been the foundation of Bluewater's success?
Sure. Our philosophy is really centered around free cash flow. Free cash flow is what we think drives the value of any business. And if a company can grow that stream of free cash flow over time, and allocate it prudently, it should be worth more over time. So at the heart of it, we're looking for businesses that can compound free cash flow at above market rates through a cycle and do it in a more stable fashion than the underlying market. So where do we find these businesses? I mean, you typically find them in areas of the market with limited competition. So think duopolies, think oligopolies, where there's often high barriers to entry, there's strong pricing power, and there's defensible moats. But importantly, these companies, they have secular growth tailwinds attached to them. These secular tailwinds, they can either be macro in nature or they can be more company specific. But these tailwinds allow these companies to grow free cash flow in a manner less dependent on the overall economy. It's what we like to call durable growth. And buying these businesses at reasonable valuations, i.e. you don't overpay for them, I think you have a higher likelihood of outperforming over the long term. Now, there's a wide spectrum when it comes to growth, right? I would say we're more conservative growth. I mean, we're not looking for businesses that can grow at extremely fast rates. So if you look at our flagship Canadian Growth Fund, on a consolidated basis, the portfolio compounds free cash flow at, call it 10 to 12% through a cycle. Some years it's going to be better than that, some years not. But if you were to look at our medium long-term track record, 5, 10, 15-year performance, our returns are really clustered around that 10, 12%, right? And that's not by accident. It's a byproduct of our process. So that's really our sweet spot of the business we're looking for. And I think this is important because, despite all the volatility in the markets, despite these massive rotations into areas like value or growth that we've seen more and more of recently, that's impacted relative returns. But I think what's often overlooked is the consistency of our returns. And I think that's where we've added value, is the consistency.
That's a great way to kick off our conversation, Shah. I want to ask a quick follow-up. Now, most managers would argue that they also buy great businesses at reasonable valuations. I want to understand how you stand out. From your perspective, what's your edge?
Yeah, that's a fair point. I mean, I think one of the ways we really differentiate ourselves is we're constantly looking for structural changes in the macro environment, right? Structural changes that are material enough to drive a step function change in the performance of related sectors, related companies for extended periods of time, positive or negative. And we adjust the portfolios accordingly. So why do we care, or why does that matter? Well, when you look back through the history of the stock market, we find that every decade has seen an underlying secular change, and that drove outsized returns for certain sectors, certain businesses. And you just don't want to miss out on them, right? So how do we do this? How do we formulate our worldview? Simple, we listen, right? It's a bottoms-up approach based on what companies are saying, what they're seeing out there. And right now, we think 3 large structural trends that every investor needs to be mindful of are the energy transition, digitization, AI, and also what's happening in China, particularly as a Canadian investor.
That's a great lead in. I got to follow up on that. I want to get to your sector exposures and the positioning in a moment, but you did mention China. Canadian investors need to be thinking about China. Can you expand on that?
Yeah, so I mean, when it comes to China, it's particularly relevant for any Canadian investor, just given our resource heavy TSX. And you need to have a view of what's happening in China. And when we look at China, we see deep structural challenges and we see a difficult decade ahead for the Chinese economy. And by extension, the commodity space, right? Why is that? Well, all of the pieces that drove China's growth, they're kind of unwinding at the same time. Globalization is shifting to regionalization because of political considerations, and also companies just diversifying their supply chains, right? Urbanization is plateauing, and with that, the need to build the infrastructure. You also have demographic headwinds. So the working class expected to shrink over the coming decade is going to be a huge headwind for the economy. It is very difficult to grow an economy when your working population is shrinking. So we think it's going to be a huge headwind for global growth, a headwind for commodities, and also oil demand by extension. I mean, China would have been something like 50, 60% of global demand for virtually every industrial commodity under the sun at the peak. And going forward, a lot of the growth projections, demand forecasts for various commodities are just going to prove to be overly optimistic. So it's one of the big reasons why we've avoided the commodities. It's because of these structural headwinds out of China.
That's an interesting point. And as I look at the positioning of your fund, first of all, it doesn't look anything like the benchmark, but also near zero allocation to materials and to energy. I'm assuming that intersects with your view on China. Is there anything else that you wanted to share?
Yeah, I mean, there's another dynamic here that, when it comes to commodities, and that's the whole energy transition, which benefits several commodities like lithium or copper, right? A few things on that. First, demand from the energy transition is still a small part of the overall demand picture for commodities, and certainly not enough to offset any weakness out of China. That's one, right? The other thing is you have to contend with technological change in that the battery chemistry keeps changing. What a battery looks like in 10 years is anyone's guess. All I know is it's going to charge faster, longer range, but the actual chemistry, who knows? So you don't want to be stuck with a commodity that just gets disintermediated, kind of like what happened with cobalt a few years ago. Now, on this, interestingly, a recent wildcard that's emerged is AI. And I think AI makes the technology roadmap even more uncertain, right? Just look at what Microsoft's doing with Pacific Northwest Labs. So they basically trained this new AI model on material science. They fed it every element we know, all of its physical properties, and basically told it to go out find new battery materials. It comes back with something like 30 million possible materials. Way too much. So you put in some constraints, and ultimately that number gets reduced down to around 18. 18 that actually seemed promising.
Wow.
And it did that in 80 hours. I mean, this is something that would have taken years, if not decades. But I think the most fascinating thing about that is that some of these materials we thought weren't even physically possible, right? So think about that for a second. It changes our understanding of material science, it accelerates the pace of change, and frankly, it makes it even more difficult in having any strong conviction in one commodity. So, I mean, that's kind of the basis of why we haven't owned commodity businesses. It's because of China, it's because of the technology roadmap.
That's remarkable, Shaw. I wanted to ask you a follow up question, and I'm going to come back to China in a moment, but you mentioned AI. For me, for most other investors, lots of talk and chatter about AI this year. It's felt overwhelming, but you're the expert. Can you help us cut through the noise and better understand what's really going on as it applies to generative AI?
So right now you're essentially in the infrastructure build out phase. So you're seeing these hyperscalers, the Microsoft, Google, Amazon, Facebooks of the world spending billions on billions of dollars on rolling out these massive data centers in essentially this build it and they will come strategy. So it requires this upfront investment in hardware, primarily semiconductor chips, and that's benefited hardware companies like Nvidia immensely. So you build out this enormous capacity, but the challenge is that the revenue generating opportunities or the use cases, they're still quite limited. I mean, most companies we're hearing they're trialing or they're implementing some tools, but I mean, outside a couple of obvious areas like customer service or coding, the widespread adoption has yet to show up. So to justify the hundreds of billions of dollars that have been spent and also projected to be spent over the next few years, AI has to become a big part of what companies and end users are doing. And that's the part we're having trouble seeing. And that's where we see the danger in owning companies that have been significant beneficiaries of what's been happening throughout this build out phase. And look, there are precedents for tech companies overbuilding capacity and then experiencing this so called digestion cycle. So, a similar thing happened in the late 90s when the internet was rolled out. So, a tech bubble was created then because the spending on build out the internet went way ahead of the use cases, right? So I mean, think about it. The iPhone only came out nearly 20 years later. So there's this chasm between the emergence of the technology and all the use cases. So what happened then? Spending on the infrastructure slowed and it transitioned to replacement demand. And companies like Cisco, that was directly involved in the build out phase, just fell off a cliff. So, I mean, if it's one thing we do know from the past, it's that infrastructure build out cycles, they don't last forever. We've seen this rodeo before. So, you want to be careful of leaning into the hardware side too much. So, businesses that are tied to that upfront capex spend.
That's a really great perspective. Thank you. I just want to wrap up our prior conversation with respect to China and the resource space because you make a great point. If we look back at the most recent stimulus announced in China, it is very consumer focused versus the types of announcements we may have seen 10, 15 years ago that would have been very focused on infrastructure, providing a tailwind to resources. What would need to occur for you and the team to change your view, say, just on the energy space?
Well, I mean, let's back up for a second on the energy space, right? We put out this piece in 2016, 2017 on the energy transition. And it's not just China here, right? It's also the energy transition, which is global in nature. We've had no exposure to energy since then. And basically, we don't view it as a growth sector at all. Um, we think that the energy transition is going to put downward pressure on oil demand going forward. We're not saying demand goes to zero. Oil touches many parts of our everyday lives, but you're seeing demand getting picked away from the energy transition. It's driven by environmental considerations. It's driven by national security, energy security. But at the core of it, it's economics. A lot of these technologies have become or are becoming cheaper and frankly better. So, I mean, let's look at EVs. We've been hearing the slowdown in EVs, but it's very much a North American phenomenon. But penetration continues to go up globally. Norway's a great case study. EV penetration went from 10% 2013, 95% today. By the end of the year, you won't be able to purchase an internal combustion engine car in Norway. They're going to be banned. So the transition just follows this S-type curve, and we've seen it with other technologies. It's digital cameras, flat screen TVs, where you have a superior product at a lower price. Why wouldn't people adopt it? So what did this do for oil demand? Oil demand's down 15% in Norway since 2016, right? And it's not just Norway. China's following a similar pattern. China's reached 10% EV sales in early 2020s, and projections are that they're going to be over 90% 2030. So Sinopec even came out not too long ago saying they expect oil demand out of China to flatten out by the end of the decade. You compound that with the structural headwinds I was talking about earlier, and their desire to reduce the dependency on oil for national security purposes, energy security purposes, and the demand picture looks quite bleak for us in terms of oil demand. But there's another side to this, and that's the whole supply side for oil. And when we look at the supply side, OPEC has shown remarkable discipline, balancing the markets, pursuing a strategy over price, over volume, which is a clear positive for markets. I mean, it's diametrically opposed to what they did in 2014 when they were pushing for volume over price. If you remember, oil went from 90 to $25 because they wanted to gain market share from US shale. Now, the problem is you can't just keep cutting production to balance markets if demand is slowing on the other side and non-OPEC production continues to ramp. Because what's going to happen in theory is that you have to keep production until you're at zero, which is unsustainable. It doesn't make sense. So I think the announcement not too long ago that OPEC, they're not renewing their production cuts, bringing back 2.5 million barrels over the next year, is basically admission that they can't balance markets alone. Now, you've also been reading articles about how the Saudis may abandon their $100 price target and pursue market share as well. So that's a clear negative for markets as well. So, I mean, that's a backdrop. Demand is slowing. China's one part of it, but there's a lot of other pieces there, and supply continues to ramp. So, not a great setup from an investment perspective. We don't view it as a long term sector, and no changes to our positioning.
That's great detail, and it really helps align with the investment philosophy that you kicked off our conversation with. Looking at the positioning, though, I also do notice that right now the team likes industrials. What's behind the view there?
Yeah, I mean, industrials is a significant overweight position. A few things here. First, from our perspective, I think it's just a classification issue, right? We have some service oriented names like Thomson Reuters that are just lumped into the industrial sector. And reality is, it's just not your typical industrial business. It's much more stable in nature. It's software, large base of recurring revenue, not capital intensive. In fact, they don't even serve industrial clients. So it's really a case of mislabeling. Now, the rest of our businesses we own in industrials, they're not your typical deep cyclical metal bender type industrial companies. They specialize in a particular niche. It drives superior growth, superior profitability. And broadly, I'd say that a lot of the bigger picture tailwinds out there that we've been talking about, like the energy transition, they're either industrial oriented or they're spilling into the industrial world right now. So if you look at industrial holding, businesses like Schneider Electric, Stantec, Train Technologies, they're all beneficiaries of the energy transition, but they also touch different parts of the energy transition. So it's very diversified. But I would say the common theme is that our industrial businesses, they all have secular tailwinds attached to them. So they're not as cyclical as you would expect. And that allows them to grow in a manner less tied to the overall economy. Back to our process, back to our philosophy.
Makes a lot of sense. I want to ask you one question that's been on my mind recently, Shah. In my conversations with those in the industry, growth versus value is once again a raging debate. What's your view? You're a portfolio manager who also oversees Canadian equity mandates.
Yeah, so this is really a sector discussion. So let's step back for a second. Throughout history, you've seen these waves of growth or value. In the 90s, you had the build out of the internet. It drove strong returns for technology, telecom stocks. It was a growth market. In 2000s, you had the rapid industrialization of China, strong returns for commodity stocks, value market. In the 2010s, you had the emergence of the iPhone, cloud computing, and it drove strong returns for FANG stocks. Again, return to growth. So each of these periods, something important changed in the underlying macro environment that drove outsized growth in revenues, earnings, free cash flow for the related sectors, which resulted in this outperformance. So from our perspective, interpreting these periods as growth or value, I think is misleading at best because while you can say that the 2000s was a value decade with perfect utility because of the sectors that did well, i.e., commodities, but it wasn't necessarily value that mattered. It was because oil went up significantly, as did other commodities that drove huge wave of earnings, free cash flow, and that's what drove commodity stocks higher. Similar story in the 90s and 2010s. Growth decades, sure, but it's because something changed in the underlying macro and IT companies benefited immensely. So we're really asking ourselves what changed in that underlying macro to cause outperformance. So as we sit here today and head into this new decade, we ask ourselves yet again, do we see any dominant structural changes on the horizon? Back to our philosophy and process, right? One of the ways we differentiate ourselves. So we're looking for something extremely large where impacted industries, companies see a step change in performance for an extended period of time. And in our view, the areas that hold most promise, like I said, were the energy transition, AI. And whether it's a growth or value market depends on which sectors that are impacted. But our approach is getting to the core of what causes outperformance.
That makes a lot of sense, and it brings to mind my final question for you, Shah. We've spent a lot of time talking about structural changes, but with regards to the portfolio, the majority of the businesses you own aren't actually attached to any of these themes. Do I have that right?
Yeah, that's exactly right. I mean, I don't want to leave this impression, that we're thematic investors. The majority of our portfolio is just this collection of high quality compounders of free cash flow with idiosyncratic growth drivers. So I guess maybe just an example to share in Canada, Altus, neat little Canadian company. And what they basically do is provide software data solutions to the commercial real estate sector. Their core strength is essentially the valuation of commercial real estate. And you may not know this, but their software is actually taught in over 200 universities globally. It's considered the gold standard. And that's used by commercial real estate managers in things like acquisition, disposition, or development of commercial real estate properties. So they're mission critical. It's deeply embedded in the workflow of their customers. Long-term sticky contracts, 90% of their revenues are recurring in nature. So lots of visibility. The important thing is, and I know there must be red flags going off everywhere as soon as I said commercial real estate, but they don't exhibit the cyclicality of the broader real estate market. And proof is in the pudding, right? Even when commercial real estate transaction volumes, values were significantly impacted, their analytics business grew 9% organically in 2023. And this year, they're expected to grow at mid to high single digits organically with margin expansion. So growth that's less tied to the underlying market, that's the definition of durable growth. Now, what's driving this? Like, what's a secular tailwind here? If you step back and look at the broader commercial real estate industry, they've really been these dinosaurs when it comes to adopting technology. They typically rely on Excel spreadsheets to manage their complex businesses. And right now, it just appears the industry as it is at an inflection point in terms of technological adoption, kind of like what happened to banks and fintech several years ago. And Altus is really at the forefront of this. They're the disruptors. They have the most comprehensive solution set, and they're benefiting from this tailwind, which we think will be there for many years.
That's great. Shah, I have really enjoyed our conversation today. I think that's a great place to end our discussion. Thanks again for joining us, and I look forward to next time.
Thanks, Rajan. Pleasure to be here.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.